Investing can be a complex and challenging process that requires careful planning and execution. While there are many strategies and approaches that investors can take to achieve success, there are also several common mistakes that can derail even the most well-intentioned investment plans. In this video, we will explore 10 investing mistakes to avoid, and offer tips for how to steer clear of them. Before we begin, please subscribe to our channel, if you are not subscribed already, and give us a like and comment. Now, let's get back to the topic. These are 10 of the worst investing mistakes you can still make in 2023 and how you can avoid them. 1. Not diversifying your portfolio. One of the most fundamental principles of investing is diversification. Diversification refers to the practice of spreading your investments across a range of different asset classes, industries, and geographical regions. The idea behind diversification is to reduce your exposure to any single investment, which can help to minimize risk and volatility in your portfolio. Unfortunately, many investors make the mistake of putting all their eggs in one basket, either because they are overly confident in a particular investment or because they are simply unaware of the benefits of diversification. This can be a costly mistake, as a single market downturn or industry-specific event can have a devastating impact on a concentrated portfolio. To avoid this mistake, investors should aim to build a diversified portfolio that includes a mix of stocks, bonds, and other assets. They should also consider investing in a variety of industries and geographical regions, as this can help to further spread risk and increase the potential for long-term growth. 2. Chasing fads and trends. Another common investing mistake is to chase fads and trends. This can happen when investors become overly focused on the latest hot stocks, sectors, or investment strategies, and fail to consider the long-term fundamentals of the companies or assets they are investing in. For example, during the dot-com boom of the late 1990s, many investors poured money into internet-based companies with little regard for their actual business models or financial performance. When the bubble burst in the early 2000s, many of these companies went bankrupt, leaving investors with significant losses. To avoid this mistake, investors should focus on building a well-rounded investment portfolio that is based on sound investment principles rather than chasing the latest trends or fads. They should also take a long-term approach to invest, focusing on companies and assets with strong fundamentals and growth potential, rather than short-term market fluctuations. 3. Overreacting to market volatility. Market volatility is a fact of life for investors, and it can be tempting to panic and sell off investments during times of market turbulence. However, this can be a costly mistake, as it can lead to missed opportunities for long-term growth and compound losses over time. To avoid overreacting to market volatility, investors should focus on the underlying fundamentals of their investments and stay true to their long-term investment plans. They should also consider using a dollar-cost averaging approach, which involves investing a fixed amount of money at regular intervals regardless of market conditions. This can help to smooth out the impact of market volatility over time. 4. Ignoring fees and expenses. Investing comes with fees and expenses, and failing to account for these costs can eat into investment returns over time. Common fees and expenses include trading commissions, management fees, and expense ratios. To avoid this mistake, investors should take the time to research and compare different investment options, and pay close attention to the fees and expenses associated with each one. They should also consider using low-cost investment options such as index funds and exchange-traded funds, ETFs, which typically have lower fees and expenses than actively managed funds. 5. Failing to rebalance your portfolio. Another common investing mistake is failing to rebalance your portfolio on a regular basis. Rebalancing refers to the practice of adjusting your investment holdings to maintain your desired asset allocation over time. For example, if your desired asset allocation is 60% stocks and 40% bonds, and stocks have outperformed bonds over a given period, you may need to sell some of your stock holdings and buy more bonds in order to bring your portfolio back into balance. Failing to rebalance your portfolio can result in your portfolio becoming too heavily weighted in one asset class, which can increase risk and volatility over time. It can also lead to missed opportunities for growth and diversification. To avoid this mistake, investors should regularly review their portfolios and make adjustments as needed to maintain the desired asset allocation. This may involve selling some investments and buying others, or simply adjusting the weightings of existing investments. 6. Timing the market. Trying to time the market is a common mistake among inexperienced investors. Market timing involves trying to predict the direction of the market and making investment decisions based on those predictions. However, research has shown that market timing is not an effective strategy, and attempting to time the market can lead to missed opportunities for growth and higher transaction costs. To avoid this mistake, investors should focus on building a diversified portfolio based on their long-term investment goals and risk tolerance, rather than trying to make short-term predictions about market movements. 7. Failing to consider taxes. Taxes can have a significant impact on investment returns, and failing to consider tax implications can be a costly mistake. For example, selling investments too soon can result in short-term capital gains taxes, which are typically higher than long-term capital gains taxes. To avoid this mistake, investors should consider tax implications when making investment decisions, and work with a financial advisor or tax professional to develop a tax-efficient investment strategy. Number 8. Investing in what you don't understand. Investing in assets or industries that you don't fully understand can be a risky and potentially costly mistake. Without a solid understanding of the underlying fundamentals and risks of an investment, it can be difficult to make informed decisions and mitigate risk. To avoid this mistake, investors should take the time to research and understand the assets and industries they are investing in, and seek professional advice as needed. 9. Not having a plan. Investing without a plan can lead to haphazard and inconsistent decision-making, which can increase risk and volatility in your portfolio. Without a clear investment plan, it can also be difficult to stay focused on long-term goals and make informed decisions. To avoid this mistake, investors should develop a clear investment plan that outlines the goals, risk tolerance, and investment strategy. This plan should be regularly reviewed and updated as needed to reflect changing market conditions and personal circumstances. 10. Letting emotions drive investment decisions. Investing can be an emotional process, and allowing emotions to drive investment decisions can lead to costly mistakes. For example, fear can lead to selling investments during market downturns, while greed can lead to chasing high-risk investments that promise quick returns. To avoid this mistake, investors should remain disciplined and focused on their investment plan, and avoid making impulsive decisions based on emotions. They should also work to manage their emotions by staying informed and seeking professional advice as needed. Ultimately, investing is a journey that requires continuous learning and adaptation. By staying aware of potential pitfalls and staying disciplined in your investment approach, you can maximize your potential for long-term growth and financial stability. Remember to always do your research, seek professional advice when needed, and remain focused on your long-term goals. With a sound investment strategy and a disciplined approach, you can build a successful investment portfolio that supports your financial goals and aspirations. Thanks for watching.